Euro US dollar slides below 1.2 thousand as strong dollar rhetoric revives greenback.
Swiss market ends sharply lower. For reference, the December FOMC statement.
Petrobras renews oil deals with Indian refiners worth more than $3.1 billion. Federal Reserve set to keep interest rates on hold as board remains divided.
Gold hits fresh record above $5,300 as Trump's U.S. dollar stance fuels rally. ECB's Schnabel says rates expected to remain at current levels for an extended period.
Major European markets close, notably lower ahead of Fed policy announcement.
room, of course, Fed independence.
Weeks ago. And does he make the case that we really don't need to cut rates because rates are already low?
Maintaining the rate of 3.5 to 3.75. There were, however, two dissents, Governors Waller and Myron, both dissenting, favoring a quarter-point cut this time. They kept the language that they used last time to signal a pause, saying that in considering the extent and timing of additional adjustments to the target range, that was what signaled a pause last time, perhaps telegraphing a future pause. There was also a noticeable upgrade to the economy and something of an upgrade to jobs. On the economy, they
United
said
States Fed interest rate decision meets forecasts, 3.75%.
Out there in terms of what's been happening with GDP. It had said the economy was expanding at a moderate pace. Job gains, they say, have remained low, but they say unemployment has shown some signs of stabilization. Last time they said it had edged up. They also removed some language that said downside risks to employment have risen. That's gone from the statement. They removed language saying there's been a shift in the balance of risks. That balance of risk was towards downside risk to employment. That's gone right now, too. Inflation, they said, remains somewhat elevated, removing the language that said it has moved up. New voters, Hammock, Logan, Kashkari, and Paulson. I want to say the statement overall suggests the heat has kind of cooled down on both sides of the mandate for the Fed. A little bit more relaxed about inflation, though they're saying it's still elevated. More relaxed on employment, removing that downside risk concern. And just a little bit of trivia here. I'm pretty sure this is right. We're second time in 6 months that two governors have dissented. Waller and Bowman in July, now Waller and Myron this time around, though the dissent now is for a quarter, not a 50. Perhaps that's a little bit of coming together. The last time before this past 6 months we had that, guys, was 1993. So still quite a bit of disagreement on the Federal Reserve Market Committee, though perhaps not exactly as much as we've had in the past. Kelly?
If you had to kind of sum it up one more time, Steve, just as what you think the main thrust of this is, or if there's any real surprise for markets, do you think that there is one? There's not much of a market move. I mean, the Dow's down about 47 points.
I think their hair's a little bit less on fire, and I guess I could say this for me. You know, you got two sides of the bald head here. You got the two mandates out there. A little bit less on fire on the inflation side, a little bit less on fire on the employment side. They're a little bit more like, we're going to wait and see how this all breaks. I reported earlier on your show, Kelly, that there's going to be two things: a noticeable break to the downside on employment, or an obvious cooling of inflation. Those things, as you note, the Federal Reserve is above the general belief of where neutral is. It's toward the high side of neutral. That's the way Powell has described it. So there's room for them to come down. But coming down now, I think, is going to require an obvious kind of break. It's not going to be a kind of judgment sort of thing at the margin. They'll do it when employment looks like it's if it's weakening very substantially, or they'll do it if it's obvious that inflation is headed towards the target.
Yeah, absolutely. Steve, thanks. And stick around. We'll see you again in just a moment.
All righty. So how are you? So they didn't cut, they didn't raise. They did exactly what we thought they would do, and that is Nothing. So now we got a big press conference coming up. And just like Steve Leishman of CNBC just said, well, we don't have collapsing jobs and we don't have outrageous inflation that's skyrocketing, nor really coming down much. So there's no need to cut, right? Kind of thing. So now we're going to get to the press conference in 30 minutes, and it's going to be more drama than important changes in economic outlook. There's no summary of economic projections. There's nothing going on in employment, nothing going on in inflation, and lots of politics. Powell is now criminally indicted. Oh my God. We got Lisa Cook. And I guess that's also a criminal indictment, right? So anyway, so there's a lot going on that has nothing to do with economics. So that's what the press conference is about. So it's kind of, I don't know, it'll be fun and interesting, but sort of pointless. Kind of like watching a dating reality TV show. Yeah, kind of pointless, but I guess entertaining. Yeah, for some at least. So yeah, that's the big thing. So we'll wait for that press conference, and then we can watch that together. And I'm looking for something on the other screen. I don't see you. Probably. So we're looking at our spike radar, and it's still in beta mode. Um, although somebody took down the beta warning. Thank you. So it's a little glitchy. Like, for example, it still says incoming. This is supposed to show. So the way that this works is no matter where you are in our analytical platform, you get a heads up like, hey, important news is about to come out. And this is what it is, and it's a spike alert. Is it for everything? No, not for everything, just things that spike the news. So it's the next generation or iteration of our previous calendar that was spike based, but in more of a traditional calendar format. And so we'll, first of all, we identify what I think is important. And what I think is important is the macroeconomic data that goes into our analytics. So that's the data that Aiden needs to make his macroeconomic calculations, like interest rates, like inflation. So that's why you can see we have Sweden coming up and EU coming up, same type of thing. Well, we've prioritized those because we gather that, put that into our database, and then we can compare Sweden to Euro to the United States to Japan using the same data inputs. Cool. Then the next stage is populate everything with 3 years of data. We ran into a snag with that because it turns out we're looking at every news event for 3 years, so that's 36 events, times 55 assets, times 60 candles times each of the scenarios. And it turned out it's just a lot of data. You can add that up. I think it's 2,200 data points per news event on the calendar. Yeah. And then, anyway, so it was a lot. So now what we're doing is prioritizing the first year over the 3 years, and not every currency pair, only the ones that we really care about. So I said dollar pairs, yen pairs, stock indices, gold or something like that, right? We don't need to analyze USD Turkish lira because we got an event last week. It said, oh my God, we expect this news event, and it was some benign news event, to move the market 9,200 pips. But when you clicked on it, it said, well, the thing that moved the most for that particular news event was USD Turkish lira. So at 9,200 pips doesn't even buy you, a dirty chai latte at Starbucks. It sounds like a lot, but it's not. So we don't really need to analyze that and get a warning like, dude, Turkish lira is about to pop. Well, 9,000 Turkish lira. What does that buy you? A Coke? So it's certainly not 9,000 euro dollar pips, right? So anyways, so we'll refine that. And then last stage, once we have everything that's super important, quantitatively analyze for volatility. Not just assume. See, like a regular calendar just says, well, the Fed interest rate's important. Okay, great. I'm not going to disagree with it. I'm kind of doing that as well because I'm saying, well, I want to gather that. Well, how important is it really? And there's lots of other things like how important is durable goods? How important is retail sales? How important is ISM? Services or manufacturing, which one is better? Well, a typical calendar would say, I don't know, they're both important, and we're not sure how important, so we'll put medium. Instead, what we'll do is quantitatively, like how much does it move the market on 3 time frames, on 3 situations, going back years, and then calculate per pip and what to actually trade. Now, I don't think the Swedish stuff's even there. But, like, for example, this still isn't loading. It's supposed to have loaded new data. Let me see. I didn't want to mess with it too much. We have the data in the back end. It's not showing it in the front end, and I don't want to kick it too hard. Okay, so I might break something. So anyways, for the sake of argument, let's say the data is complete. We're looking at right. We're looking at the Fed interest rate decision, and 0% probability the Fed was going to cut. Cool. But I mean, raise 0% probability they were going to raise. Okay. Based on past performance, not based on consensus, not based on some AI version of analyzing macroeconomics and monetary policy and the individual personalities at the FOMC or stuff like that. Like, no. It's just saying in its history. Now, it's supposed to have 36 data points. It has 2. All right. Well, in that history, what's the probability the Fed raises when the market expects not a lot, right? No cut. Well, anyways, well, it ain't going to happen, but in situations in which it did, so therefore we do have the data somewhere. Every time the Fed raised interest rates unexpectedly, 37.5 pips. Okay, and you see how, okay. So USD yen moves more than euro dollar. So it says trade USD yen, trade gold, then euro dollar, then the S&P 500. And that's all this data for beats. But one of the things it's doing is calculating based on past performance of Fed behavior. It doesn't predict future results, but it's saying in the past, the Fed's just never surprised the market by raising it. So there's a 0% probability. Now, in the past, the Fed has met expectations half the time and beat expectations, cut interest rates unexpectedly, right? 50-50. Now, again, we're only analyzing 2 data points, so it's not good, but it's good enough to understand, like when we have the 36 data points fully populated in this analytics, we can say, well, has the Fed been beating the market or meeting the market expectations? Are they hawkish or dovish more than the market? Is the consensus usually right, usually wrong? And if so, it shows the surprise. If there's a surprise cut and nobody expected it, does it move the market? And if so, by how much and on what asset? And it looks like for these pairs, okay, euro dollar actually moves 20 pips. And then check this out. Euro dollar moves 80 pips on the surprise. So again, it's quantitative. We're not saying, well, I don't know, is the Fed interest rate decision important? Is it a market mover? You would assume so. Now we tell you the answer to the question is yes, and by how much? Quantitatively. Still waiting. Now I have a feeling if I refresh the page, we lose this data. But anyways, I think you can see we're well on our way to something really cool. So now imagine you're not even looking at this page, but you're out doing TRADARS stuff. You're doing analytics somewhere, and it pops up, and you get the alert that it's about to happen. I'm also thinking about creating an email alert service because we already have emails alert services. So if you already have one, you will already get it. But I'd like to add to the email alerts an alert for high probability risk events. So that, let's say, I don't know, a few hours before it comes out, you're notified and you're like, dude, if it comes out less, if the Fed cuts, euro dollar in the past has moved an average of 80 pips in that scenario. And we'll tell you the direction. And we have all the charts to show you how the velocity in which it got there. I guess I should show you. Oh, look, we already lost our analysis here. So, yeah, so isn't that neat how the page refreshed without me refreshing the page? It's because this isn't a web page. Let's see if we can get something popular. So we can show you what the market did in the past. A met and a miss for these news events. So imagine now you have 3 years of all that summarized and sent to you directly as like, hey man, just want to make sure you know that this is on the calendar today. Okay. Of course, you find in our
Chairman Powell explains the decision and responds to
Squawk
media
Box, too.
questions.
Gold pulls back from $5,300 on hawkish hold by the Fed. Dollar recovers as Besant rules out currency intervention. Fed holds. U.S. dollar holds steady following Fed rate hold. Euro U.S. dollar remains steady as Fed holds rates. Markets brace for Powell appearance. Breaking. Federal Reserve keeps interest rates unchanged.
United States Fed interest rate decision meets forecasts, 3.75%.
Federal Reserve rate decision. No change to Fed funds, as expected. So we clearly know the Fed kept interest rates the same. So that's the other thing that you can do with TRADARS, remember everything you've seen so far is free at TRADARS. Everything's free at TRADARS. Everything you've seen. These are the premium levels in our premium model, but everything you see here kicks mighty butt, and it is free. So one way to do it is you log in, and then you just run this page in your background, just minimize it, run it in the background, and you have a Squawk Box. A lot of people pay $1,000 a year for something like that. I used to pay $3,000 a year for something like that. And now it's free. Cool. Cool. So let's go through some of this. These are I like them. They're this is one of my favorite pages because I am more of a swing trader these days than I am a scalper and even a day trader. Because if I'm going to go to all the work to make a day trade, I might as well sit on it for a couple of weeks. Why not? And so this is where this comes in, where you can really get a clear sense of where things are going right now. Oil's on the move, and it's amazing, not amazing, but it's very interesting because for about 6 months we were solidly bearish. And about a week and a half ago, we turned bullish. After 6 months of bearishness, now we're bulls. Now, seasonally, we know that that's likely to come true between now and April, but now is now. It might be happening now. So I'll be sure to take a look at that in a second. Okay. So we're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 assets on 3 time frames. And then we're correlating them to volatility, meaning risk on, risk off scenarios. And with those calculations, and then weighted each one, short term is important, long term is important, just not weighted as much. So now, right, short term, medium term, and long term, all weighted together. So you get a daily, weekly, monthly, and then an overall between them, right? Because they have their individual scores, and then you weight them. For a total score of the market is slightly risk off, and we have the history of risk sentiment, which is something that we never had before at TRADARS. We never had it. We couldn't do it. We knew what was happening in 3 categories of short term, medium term, long term. That was it. So we had these 3 numbers, but that was it, which is pretty good, right? Like those are our old risk gauges. Well, that's good, but how is this different from yesterday and last week and last month? What's the trend in risk sentiment? And so now that we have this, and it's epic. So we ended the year crazy bullish. We had our little dip. By the way, we expected this dip. And I also know through seasonality that very often this week is an up week, but continuation down is not unusual at all. And then there's a turning point that comes after that, which is the one that lasts. So for many, actually a couple of decades, I've been talking about a 3rd week false rally. And this might have been it. Even if it goes up the rest of this week, it still might be a false rally in the back of our minds as we look at technical analysis, so that you know how to weight your conviction scores for things like, is that a double top? And if so, how important is it? What's the likelihood that it could hold and drop something? What's the likelihood the double top will actually form and be respected? Well, if you don't know what's normal, then you don't know how to apply probabilities, because you need the benchmark, and then you have to say, well, then what's unique about this situation? And so if it normally holds and normally drops, you might put some weight on that and say, well, this is a time for a double top. I should at least perceive the risk coming and protect myself. Or, instead of seeing it as a threat, it might be an opportunity, because then you can say, well, down for 7 more weeks, and then we'll be up for 16 weeks. You're like, Wayne, you can do that? Yeah, that's what TRADARS does, right? I need some coffee. Do you mind if I get a coffee? Let me get another coffee. BRB. Found a glitch on this page. Wonder if it just needs some time. Be right back. That's some good coffee. My secret is cold brew your coffee, and then cold brew mushroom coffee. Blend them together. Yeah, and then let them sit overnight in a cold coffee pot. And then add butter to it. Yeah. All right. Yeah, I found the strangest glitch. So the page loads, and when I click it, the analysis is slow or does this. I do a soft refresh, not even a hard refresh. And it works now. How long do you think it'll take to figure out what's going on? I'm like, well, I guess I got my weekend planned. What are you guys up to? Oh, we're going to the beach. Oh, we're going to the mountains, go skiing. Oh, I'm going to sit under my deck, smoke cigars, and try to figure out why the heck the front end glitches and fix it without breaking anything. Oh, that sounds like fun. Anyways, let's, for those that are not familiar with TRADARS, check this out. First thing with this page is you can separate everything by basket, because I'm a basket case, right? I'm a basket trader. I like to buy or sell all dollar pairs, or buy and sell all yen pairs, or buy and sell all Swissy pairs if the market's trending. Yeah, so I have to figure out, well, is the market trending or not? Well, right now it's risk off. How do I know? I just analyzed 14 different investor markets or asset classes on 3 time frames, weighted them, and can see we're not analyzing the news. We're not analyzing what the Fed put in their statement. We're just watching 14 different markets on 3 different time frames. So we know what bond traders are doing. We know what gold traders are doing. We know what stock traders are doing. We know what oil traders are doing. We know all these different things. We know the yield curve, what area of the curve they're trading. When you add all that up, we are slightly risk off right now. All right, cool. So now I can go to this page and have a determination of what I want to do. Okay, based on that knowledge. But when I let me close this, what do we know? Well, these are 3 time frames, but they only go back like maybe a couple of days maximum for the swing. Then we look at yesterday, and then we look at over the last 4 hours. Short, medium, and long term. Now, I can very quickly take a glance and say dollar week, dollar week, dollar week, dollar week, dollar week, dollar week, dollar week. What do you think? Is the dollar strong? No. I just analyzed 1, 2, 3, 4, 5, 6, 7 charts on 3 time frames. I just looked at 21 charts, analyzed them for trend, and then did a comparative analysis and then put them in a basket. Boom, dollars week. That's it. Now, on what time frame? Well, euro dollar, okay, has euro's been beating dollar, but right now we have had a nice little pullback to the 1 standard deviation below the mean with, so now I'm only looking at the long term, okay, with, there's our standard deviation calculation, with a positive slope calculated per hour, and we're right about there. Like, if it goes up, then we are going to take it north, and that's what we call a swing trade. We don't know if it's going to happen, but we do know based on, well, once again, past performance doesn't predict future results, but I can use past performance to do a linear projection. So even if this drops, then we can see technically the up has slowed down and might reverse. Now we can analyze it just going back based on what happened over the last 24 1-hour candles. So yet the last 24 hours. We can calculate the slope of the mean and the standard deviation, and that's where we are now. So now we got these two kind of lined up. They're not quite the same, but they're about the same. So now what do we need to do? All right, so far today, euro dollar's been down. How do I know? Well, this is going back, I think, is it 4 hours or 12 hours? I'll have to double check. Well, I guess we can do it here. From 4 a.m. until now, 8 hours? So in the last 8 hours, euro dollar's been down, but for the last few days it's been up. So what are we looking for? We're looking for a buy a dip scenario. Well, son, don't call me daughter. Hey, it's been pulling back. Has it reversed? Not according to our analysts. We gotta move over, huh? So you're looking for that buy a dip scenario, and we're at the point where it might be very interesting for you to pay attention. Okay, up, 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 flat, flat, down. Up, wow. Up, wow. See, we have all this data from earlier this morning. So these were opportunities we identified earlier this morning, and they've broken out. Okay, this one has not broken out yet. This one is flattening, so imagine it being sort of a bottom that might be forming. You got a higher high here. Are you going to buy the next dip? Well, it's even got, right, the slope of the mean. So you can sit, and this page updates without you having to refresh the page. So you can just sit and wait for the short term to line up the way you want it. All right, hang on. So let's go to the press conference.
Indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. Since last September, we've lowered our policy rate 75 basis points, or 3/4 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We're well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep...
What about me? It matters to me.
Thank you. I look forward to your questions.
These are our swing trade plans, by the way. Crushed it.
Gaber at Associated Press, thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timbers, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to, this is really about the press conference and the economy and what we did today, but and some ancillary.
I told you nobody
Can
would
you say
care.
whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Hey, I want to talk about the economy.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve?
Oh, this is a good one. Thank you, Michael.
Tell us what it is, and if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today, that either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm, there's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite...
What a funny event. I knew it'd be funny, but this is funnier than funny.
What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
I mean, what's your view on the market movements? I mean, what do you think behind them? Is it asset managers diversifying? Is it...
Yeah,
diversifying?
We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Wow. This is crazy, huh?
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market and the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Well, Mark says I ran a video. I don't run ads. That's YouTube. I don't run ads.
You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the S&P and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range. But so for some people, they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course, no one knows with any precision. So, if you had a follow-up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out.
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira. Thank you, Chair Powell. Amira Mokwe from Bloomberg News. To what extent did the committee discuss the possibility of
Fed's
cutting
Powell.
at this meeting
Inflation
or in
remains
March?
somewhat
And how are you all
elevated
thinking
relative
about
to
the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook and all that. And, we're in a position where, we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to employment have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain, but most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2% x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a 2-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on...
Yeah, clever. I agree.
...actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy is in a good place. I've just discussed reasons why we might change our policy.
I'm trying to fix this flashing.
See how the data lead us.
I'm wondering, a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens.
No, all of this was known,
notably
Richard.
in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked.
It's priced in all the way to June. We'll do that in a second.
Market-based
Or
short-term
at the end.
inflation expectations have come way down. You know, they were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are, very consistent with 2% inflation over time. So expectations have been solid, and they reflect, confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made, you're right.
You're not going to efficient market
We
theory,
saw the
are you?
labor market weakening, and we acted. And I think that was the appropriate thing to do. We will always act to address what we see as the economy moving.
Sorry to keep refreshing the page. I'm trying to get rid of that little glitch.
Risks to both of the variables are a little less. I think that the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that. I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot, really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But, right now we're running a very large deficit at essentially full employment. And so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with. And then, in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, I mean, technically, higher longer-term rates means less accommodative financial conditions. But remember, many, many things move longer-term rates. It's not, and it's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but, you know, it's much more, you know, assessments of the fiscal path and fiscal policies and risks and things like that that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate and over the course of a year, and over the course of that year, the 10-year is exactly where it started. So it's not, there's not a tight link between, you know, 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between, to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, you know, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the U.S. context, this is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's, first of all, it will be hard to restore the credibility of the institution if people lose their faith that we're making decisions, you know, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Archie Hall from The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. You know, supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, you know, it shows, it's a survey.
I got that data right here.
Job availability is, it's a very low reading. Just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll jobs softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. You know, so imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And then one more on growth and the kind of strong growth outlook, your strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially the economy has once again surprised us with its strength, not for the first time. And consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time.
That's the UMich he's talking about, University of Michigan.
Reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less and changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control, and frankly to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time, is rising productivity. So and we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. You know, we can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when.
What? We froze? No! Is it me? Is it you? Is it my PC? I've been doing a lot of background work, chunking away, and did Aiden just like steal my browser, my GPU? My i7's dead? Yeah, he's still talking, but I lost my processor power, I guess. Well, can you hear me? Or do you hear it in the background and it's just me not hearing it? Let's see. Trying to find the glitch. Yeah, that's what happens when you're doing work in the background. Oh, I mean, I don't need to hear more. I found but so let me wrap up because we understand they didn't cut, and he didn't tell us anything more. Really, they're probably going to be on pause until June. How do we figure this out? Cool. All right. So we go to the Fed Watch tool, and we calculate the rate probabilities of interest rates in a particular time in the future based on the pricing of futures contracts. Fed fund futures. Kind of like analyzing the yield curve, which we were doing earlier on TRADARS example. You can analyze yields. This is also showing you if money is coming in or going out. So you see the flow. Then you see where on the yield curve of the flow. And then you can see the implied yield of each based on the yield curve. And then we track the change of that over 30 days. I know it's complicated, right? But why do you track the shape of the yield curve and the flow of the yield curve? To derive what the market thinks the Fed's going to do. I mean, really, and by that I mean future. People are placing money based on future interest rates. And this is where they're placing their bets, and we can see that. Well, if you track specifically the Fed funds rate, like if I go back here, 1 month, 3 months, 6 months, money came out of the 6 month and went into a 1 year. More went into a 2 year, about the same into a 5 year, more in the 7 year. And then the long end of the yield curve got quite flat. So money came out of the 1 month, they're not going to cut, and they went into the 3 months. Why? They're probably waiting for the next major Fed meeting with the summary of economic projections, and they say, well, the probability is higher here that the Fed cuts, so I'm going to sell this and buy that. Are they right? We don't know. But we can check a different market and kind of read into these tea leaves. So of the thousands and tens of thousands or hundreds of thousands of Fed funds futures contracts, when dealing with today, the average price of each contract $96.36, for which in the future you will receive, for a loan of $96.36, in the future you will be paid $100. Now, you do the math, reverse engineer, what's the percentage, annualized percentage for this loan? The APR. 3.75. Cool. So now we've derived what they agreed to in their negotiations. Yeah, I'll lend you the money, but you're going to pay me 3.75. Okay. Well, what about in the future, March 18th? 86% of those contracts are still being priced in as if interest rates will also be at 3.75 way out on March 18th. Now, some of the contracts, they're saying interest rates will be a little lower, so they'll have a different price because now these people are receiving, let's say, $96 and let's say 29 cents, not 37 cents, right? But have to pay back $100. Well, okay. Now, we go further out. Check that out. Higher chance, according to these negotiations, higher chance, 73% chance the Fed still doesn't cut by April. Remember, this is true opinions through negotiations over hundreds of billions, if not trillions of dollars. Pretty legit. Well, there's only a 26.5% chance, according to these bankers, because it's bankers negotiating with bankers. Dude, only a 26.5% chance the Fed's going to cut between now and April. So when you read this in the media, like, oh, there's a certain percentage, this is all they're quoting. They're quoting that. One cut, two cuts. So right now, the media would write, there's a 25% chance the Fed is going to cut by April. Or they'll say institutions anticipate one cut by May. The thing is there going to be one cut until May? And that's it? Is there another one in the June meeting? Well, the June meeting is the meeting that Jay Powell steps down. Or do I have that wrong? He's already stepped down and we have the new guy. That actually might be the meeting in which they vote in a new chair. So this meeting here, Powell's out. Yeah, it seems right. Why does it seem right? 75% chance. Okay, 75% chance. The Fed doesn't cut at all until there's a new chair. What do you think the new chair is going to do? Play the politics side now. We're pretty sure the new chair is going to cut. That's how he got Trump's nomination, right? We're pretty sure they're going to cut. So we're pretty sure, 75% confident, the Fed doesn't cut at all until that new chair comes in. If they do, once. But probably not at all. Then you get to June. Yeah. It's right now, it's 61% chance there's a cut under the new regime. Just like that. Boom. We went from 25 to 60%. And now, over the period of time, you would track this. Now, currency traders, help me out. Why would you track this? Why would you track it almost every day? What's the use of this data? Like, who cares about the data? And yes, it's nice. Look, Wayne can calculate with the math, the probability, what the Fed's going to do in the future. Sure. Who cares? Does anyone want to answer this? I'll give you a hint by drawing a normal distribution. Okay. Mouse door. Okay, that's a normal distribution. This is our current distribution. So we have a fat right tail. What do you guys think? Why do we care? Well, the first thing is, let's take that. We'll take that. That's a normal distribution. And so it's skewed to the right. Nobody's going to answer? Everyone's got a broken tongue this morning? Well, let me tell you. Let me tell you, Lucy. All right. If we, how do we say? Let's do this. If we move this way, meaning this is where we are now, and this is a normal distribution. If this average or center moves to the left, that means the Fed is cutting. And when the Fed cuts, the dollar weakens. So you want to watch and observe, and then, of course, trade accordingly, the shift from a right fat tail skew towards a normal distribution or even a left tail skew. That would be extreme dollar weakness. Yeah. And you're like, well, Wayne, that's really hard. Well, then just watch this. If this goes up, that means we're shifting this way. And the dollar should weaken. Then the next thing you want to do is, did this move up more or did this move up more? And of course, this would come down. Why does that matter? Well, you're changing the skew more towards that normal distribution. So it's more, meaning this is what we're looking at now in the distribution. Okay, but if this went down, it narrows. If this went down and this went up, then you get something new that looks like this tail gets fatter, this gets shallow, and then this drops more. Yeah. So what happens is the mean moves more. So you're even more dollar bearish. So you're like, but Wayne, I don't trade Forex. I trade the stock market. You don't know this. You don't know what's happening. Okay. So Jim makes a point. This isn't the Fed. This is bankers negotiating with other bankers. It's not a public market. It's a private market. In theory, these bankers are smart and they have enough data and they have huge quant teams and they have huge economist teams. They have huge research departments. They have huge tracts of land, but they may not be smart. They may be wrong, and they have very often are wrong. But it is happening. This is not a survey of how they feel or what they think should happen. This is the prices they're negotiating. Cool. Now, the private market's quite small compared to a public market. So this is why I track yield curve. Okay. So notice, because we're tracking 7-day versus 30-day yields in the short run, did you notice the green line is above the red dotted line? Interest rates are not coming down in the short term. And they've been going up in the long term. Now, we've been seeing lots of red on the screen, so money is suddenly flowing back into the yield curve, but where is it flowing? It's flowing into the 2, the 5, and the 7. What does that mean? They're betting with their money in the public treasury market. Interest rates are going to fall a lot, essentially the second half of the year and next year and the year after. They're already betting that the Fed will continue to cut interest rates, not next meeting, not the meeting after, starting the meeting after that, and then continuing for many meetings, that we drop from 3.75 down to something significantly less. And how do I know this? Money came out of here. See, if the Fed cuts in the future, then if you own a 2-year, or if you own a 5-year, or you own a 7-year, you earn, we'll call it a coupon. It's not real. Treasuries and bonds are not the same, but they're very similar. You get some money a couple of times a year, right? Yeah. And that's a contract. So you have a 7-year contract. Let's say you bought that today. Like, people bought this like today. This was down yesterday. This was down this morning. So money definitely has gone into the 2, the 5, and the 7. Usually, when you go farther out in the yield curve, it pays more. Well, you're collecting 4% on the 7-year and only a 3.82 yield on the 5-year. So people are buying this. And notice, a month ago on the 5-year, you were only getting 3.68. Today, you're getting 3.82. You're better off buying it today than a month ago. All right, so in the future now, in the future, 1 year from now, or actually it looks like in 6 months, the Fed starts cutting, and they cut multiple times. Well, that will lower the yield of the new, what we call fresh cut 7-year and 5-year treasuries being issued then, way out 6 months in the future. But the one you bought today, and clearly people put money into this today, guess what? They're earning the higher rate. Today's rate. Basically, they're earning 4% for 5 years or for 7 years. And every time the Fed cuts, so in 6 months, and 9 months, and 12 months, 15 months, 18 months, the Fed keeps cutting. Well, then the new fresh cut 5 and 7s pay less and less and less and less and less and less. So suddenly now you're only making, let's say, 3% on this 5-year, or let's say a 7-year investment. In the future, they'll only pay you 3%. But then you go and you're like, well, Wayne's got one from a year ago that pays 4%. Statistically, that's a huge difference. So if I wanted to sell early, someone would have to pay me more to buy that contract, which means not only did I lock in the 4.0 today, I believe in the future that contract will be worth more because the newer comparable ones are paying less. So the value of my loan to the U.S. government has gone up, and I can sell it into the open market as a seasoned treasury, not a fresh cut. So the value of my asset went up because I'm earning a higher rate than the comparable ones. So this is what they're telling us. You see this? Clear as a bell. Clear as a bell. Because we look at this every day at TRADARS.com. We do a sometimes a 2-hour webinar every morning. And we log in, we look at this stuff, and I'm like, look at all that money that just went into this center of the yield curve. Well, Wayne, what does that mean? Oh, the Fed's expected to cut interest rates several times, just not soon. Later, in the second half of the year. So now imagine you're trading the stock market or the treasury market, or I assume it matters for crypto because it's a very macro thing, but definitely Forex. Like, if you can't see what everyone else is doing, as an amateur trader, you're doomed because you're not big enough, smart enough, fast enough. You ain't got enough money to beat the market. It's a fool's errand. Mama didn't raise no fool, hopefully. So, what is it that you're supposed to be doing every day? If you can't beat it, join it. Figure out what the other traders are doing and go along with them. And you're like, oh, that's interesting. And there's ways to do that, like that. We have an entire sentiment section, all of which is free. Look at that beautiful trade, M2. Look at that, projected to get to M4. Look at this. This just cycles. Scalping ideas, just cycles around. He's looking for another trade. How about gold? Did you see gold? Did you know we're already through the target and on our way to R1? I think we're pretty much done. But there's our projection. Now, I don't know why that just flipped bear. That's interesting. And I've been messing with the back end. We're not bearish on gold. But we have all this sentiment, right? Yeah. Yeah, I mean, Jim, like I was saying earlier today, the group I lead, the Council of Investment Advisors, we sold, I think it was like a $25,000 position in treasuries and moved a big chunk of that to gold when we were at 4,300, and that was less than 6 months ago. I think that was like 4 months ago. So we dumped U.S. Treasuries out of the portfolio because that's what I teach, portfolio construction and management. So we looked at the correlation of being in that position. We earned a lot of cash on that position, but the value of those treasuries fell. And it still wouldn't have been, when we look at that yield curve, we were positioned, the duration was positioned around the 20-year. And I just showed you the radar, the bond radar, where most of the money went into like the 2, the 5, the 7, but not the 10, the 20, 30. So I would, even though the Fed is expected to cut, they're not going to cut soon. And I don't know, it's not benefiting them. And we've lost correlation. It's different from what your dad did. We would track it because we track the correlation. We're like, okay, we like the diversification. We like the hedging strategy. The only problem is it ain't hedging. It wasn't working the way it traditionally was supposed to, and we could measure that quantitatively. So after being in it for a year and earning a lot of cash but losing a lot of value, I think it basically broke even. We're like, we got to get into a true hedge. So we analyzed the whole market, and so go back 4 months or something. We had a dip in the NASDAQ, so I think we put like half of the 25 grand in the NASDAQ S&P 500 and the other half in the gold. So we're up like, I don't know, 10% in the equity portion of that new rotation. So we call that rotation, right? So we rotated money out of treasuries. So we went into my Wall Street bank, like it's a real bank with real money. And then the council saw me do it live. They see me log into my account. And I sold $25,000 or whatever it was. I think it was about right. About 25,000 in treasuries. They saw me sell it. Then we have the cash, and then we redistributed it back into the portfolio. And I think, let's say, I think it was something like this: half into equities and half into gold. So like half it, so 12,500, and then you cut that half, some for NASI, some for S&P, and then with the other 12,500, we bought gold, and now that's up 30%. 30% in the 4 months. I think it, whatever the percentage is, I think it went from roughly 4,300 to 5,300. So it takes us like 2 to 3 hours of conversation and discussion to get to the point to say, rotate. How to rotate? How do we allocate? And before you even get to rotate, like, why? Why? Because we're afraid? Why there's a short-term pullback? Well, we're not traders, we're investors. We're managing a portfolio here. And so the why is much more important. And then once we've decided, well, what do we want to do about it? And then in this case, it was dump the position, rotate the capital, trying to get the proper correlation. And we nailed it. More happened in those 4 months than the last 40 years, if you want to think about it like that. Huh? $1,000 an ounce usually takes years, not 4 months. Years, not a quarter. Many years, not three or 4 months. So anyways, pretty cool stuff. Looking at what everyone's doing, and again, what I was sharing with you is we want to pay attention to what everyone else is doing. And so we look at the dollar index, the yield spread, that's the 210 spread. We look at volatility through the lens of VIX. We look at gold, the S&P 500, NASDAQ, the 2-year yield, and the change. Is money going into the 2 or out? Well, we saw today in. What's Bitcoin doing? What about the 10? Well, money came, I think a little money came into the 10, but way more came into the 2. And that's why we're looking at the spread. Is it widening or narrowing? And what does that mean? So we're tracking all of that in near real time. I think every 15 minutes we update this, right? So we look at the Japanese stock market, we look at oil, we look at junk bonds, investment grade bonds, the Dow and the DAX. And we're looking at this over and over and over and over and over and over and over, because we're trying to look at what are the stock traders are doing. What are the domestic versus international stock traders doing? What are bond traders doing? And where are they doing it in duration? On the front end of the yield curve, middle end of the yield curve, back end of the yield curve. Why? To see where they're putting their money, or, well, to put it differently, where are they buying and where are they selling? And then we're trying to figure, well, why? Is it because volatility is up? Well, VIX measures not volatility, but people hedging their positions to the S&P 500. Why would you hedge your position to the S&P 500? Because you're afraid it's going to come down and there's nothing you can do about it on the short run, because you own billions of the thing and you're long-term long, but you're like, dude, I don't like this. The Fed's not going to cut for 6 months. Hedge. Well, if they're afraid, we're tracking it here and then saying, well, now we can see what Treasury, traders are doing when that vol goes up. But now we know what the dollar traders are doing, what the stock traders are doing, what the gold traders are doing, what Bitcoin traders are doing, what German stock market traders are doing when USD VIX goes up. And then, of course, we measure it on 3 time frames, and then we weight it, and then we check basically every 15 minutes. What about now? What's the risk now? What's the risk now? And so we can see the entire market. This is a survey of the entire market, like the CME group, not a survey of what you think or how you feel, but a survey of where are you putting your money and in what conditions are you making those decisions, and then it's applied. If more institutional investors are hedging their exposure to the downside risk in the S&P 500 because they're afraid, well, now we can see what everyone else is doing because they're making similar decisions. They think risk off is on its way or here or going to increase. So if we track this over periods of time, well, does the dollar usually go up or down? Does gold usually go up or down? Does Nikkei follow up or down versus the S&P 500 up and down? All of a sudden we can see what happens to the Nikkei. Well, now if you know the correlation of Nikkei to Japanese yen, now you know what to do on the yen pairs. And so you need to keep an eye on this. This was negative 10, then we got to break even, and now we're negative 2.5 again. So it was great. We cooled off during the holidays. Then we had our dip, a bit of a rally back to neutrality. And now what's next? Well, this is what you need to decide. Are we going to go up in the next few weeks or down for the next few weeks? Well, you have all that macro data. You just listen to the Fed. You know what the Fed's going to do, cut or not cut. Okay? So what do you think? How's the market going to react? The U.S. economy is so stable, the Fed doesn't think it needs to do anything. Jobs are okay. Inflation's okay. We don't need to do anything. You're like, well, there's a maybe cut in April, but there's 75% chance they still don't cut in April. There's only a slim chance of one cut. Are you going to trade knowing this, or are you just going to be an innocent bystander / victim? Do you have situational awareness? I actually call this a sit rep report right here. Do you have situational awareness, and do you know the market conditions that you're investing and trading in? If you don't know that, you're just going to get run over like a freight train. And trust me, institutional investors don't feel sorry about that. You're a liquidity event. They need you to make dumb decisions. They need you to buy when they're dumping. They're like, we got to get out of this for profit. What kind of idiot would buy this? Somebody that doesn't know. Well, sell it to them. Right? They're like, take it from me. Give me your money, you dummy. Well, that should rub you the wrong way. You don't want to be the sucker at the poker table. You only get invited to the party because you make poor betting decisions when you play poker. You're like, can you imagine you find out all your friends actually don't like you? They just like the fact that you make poor decisions on poker night? Right, Richard? Can you imagine? Oh, Richard, I don't actually like you, but you're welcome to come to our card game every month. First Friday of the month. Yeah, that's why trading was introduced to retail traders, without a doubt. So when I first started as a Forex trader 20-something years ago, 25 years ago, it was a $2 trillion a day market. And I don't have the recent stats. I mean, we can find it at the Bureau of International Settlements. But the bottom line, I think it's somewhere between 7 and 9 trillion. So let's say it's 10 trillion. It was 2 trillion. It's up 500% in 25 years. Why? Well, there's a heck of a lot more money in the world. And, you know, the banks are so big, they're too big to fail. That means their positions are too big to sell. So they need a lot of dumb money. They need a lot of ill-informed traders. Ideally, ones that will throw money away like it's nothing. Like think about the behavior here. You only have $5,000. It's not a lot of money, but you want to get rich. So you open up a Forex account. You're like, I want to get rich. How are you going to get rich? I'm going to turn my $5,000 into 5 million. Bullshit. Oh, wow, that's a huge return. How soon are you going to do that? In like 20 years? No, I'm going to do it this year. I'm going to turn 5,000 into 5 million. Okay. Oh, David, let's do that next because that's so easy. That is so easy. Okay. But anyways, so then you think about the logic of that. Okay, you need a 10 billion, return on investment. You're going to do it in short order. Okay, that doesn't seem logical, but let's go from there. How much schooling do you have? I ain't got much schooling. Oh, you don't have a master's degree in financial management or a bachelor's degree in macroeconomics from an Ivy League school? No, I barely got through 12th grade. Oh, but you're going to beat people that do? Then what? Do you have any idea at all what the dollar's going to do over the next 3 to 6 months? Like something you can prove. And what about the yen? And do you understand what's going on in the yen right now and why it was super weak, then it was super strong, and it's weak, and then strong again, then it's weak again? Are you tracking Japanese politics? Are you tracking what's going on at the Bank of Japan? And are you familiar with the history of intervention going back years? Do you know seasonality? So that you can make and prepare for things in advance. So like the stock market, okay? Between now and February, and then March, and then April, like, can you prepare? You're like, what do you mean prepare? Look, this is what I've done. This is my annual outlook for the S&P 500. I just did it. It's automatically. This is what the S&P 500 is going to do, in my opinion. That's what it looks like. So it's kind of creep up, then we'll have a pullback, and then buy and hold. But an amateur trader that can't think beyond whether his MACD is crossed up or down is not going to survive this game. Okay? So here's January, and here's February. So, for example, the average and the median show some volatility, but the S&P 500 can earn as much as 2%. Now, the vol is there because some months it loses 3%. By months, I mean some Januaries. But other Januaries gain 4.5, but as a deviation. So this is what we're calculating to be one standard deviation from the mean of 2.2. 60% of the time, January is up, but by less than 1%. So January, it's got some high vol, it's got some peaks and some valleys, and it does okay, but it's not a great month for the S&P. Now, you can guess, you can trade your feeling, or you can just know. But what is important is now, if there's peaks and valleys, like let's say it goes up 4%, one standard deviation above the mean, and it does it, and when it gets there, it hits a key pivot point or a key pattern like a head and shoulders or double top or whatever, a key psychological price or something. So let's say it's monster up, then we hit resistance of whatever kind you observe, and then 60% of the time, February is down. So you can now do a peak and valley analysis, right? So you're like, Wayne, so this one's sort of flat and up, and then downish. Yeah, well, if you prefer. Yeah, I have it pre-drawn for you. So it's like, if you don't know, it's your fault, not mine. I built this for you. You should have a plan. There's my plan. I got my plan. So kind of up, buy, and then buy a dip scenario, right? And then what? Down here and buy another dip. Okay. So selling here. Okay. Buying here. Buying more here. Cool. And I have that for everything. Did you know Bitcoin usually goes up? Did you know 10-year T-note usually goes up? Yeah, usual in January. Guess what? They're not going up. Well, you should still know it's unusual, shouldn't you? Okay. There's my plan for gold, by the way. Well, look at that. That's not what it's supposed to do. Oh, how linear. Oh, I see. It did days instead of weeks. All right. Well, that's better. All right. Okay. So there's gold this year. Holy schnicker schnacker. Is that going to get us to 6,000? Well, accumulation phase usually starts in about 6 to 8 weeks from now. And the second accumulation phase starts, looks like just after Canada Day. I probably will wait for the higher high and take it in the third week of September. So I probably would like maybe buy more. So maybe the CIA, the Council of Investment Advisors, we can get together and say, hey, let's accumulate more because we have cash. And or we can rotate. See, that's what I mean by rotate or not, because we're constantly making cash in the portfolio. So since our last meeting a couple of weeks ago, I think we got about $800 to $1,000 in cash we need to invest. So what do we do with that? Okay, that's an allocation, but a rotation is, dump treasuries and move that money into gold into the stock market. Cool. So we can say this is an appropriate time to have those conversations during these dips. Should we freak out or discuss accumulation? And now in that period too, let's say like that period, you go to your charts on gold and you're looking to do proper technical analysis. You want to buy a dip. Well, at what time and what price? Well, that's what technical analysis is. But if you don't know you're a buyer, you're just doomed. All right, so let's go back to a serious question here. Somebody asked, was it Monday or David, the entries? And okay. So, all right. There's two things that are important on a day trade. Your day trade should be fairly easy if you have a fundamental bias. It's an assumption, meaning you've already made the decision. You're going to short the US dollar. Or you love Aussie dollar because it's your China. So just in your mind, you're looking for opportunities to buy Aussie versus anything. So an Aussie yen up could be good for you. But anything selling dollar, so euro dollar, pound dollar, Aussie dollar, Kiwi dollar up, USD CAD down, let's say. You should already know that. You don't know that, you're doomed because you're random. And you're like, well, my MACD told me to sell it. Your MACD on your 15-minute chart knows nothing, dude. Nothing. It's helpful to make a decision on entry, but not the reason to buy or sell. You're missing so much data that you're finding mediocrity in your returns, and you know it's true. That's the reason. It's not that your technical analysis isn't good. You're just not very good at trading. So if I can get you to look at multiple time frames, even if you know nothing about fundamentals, at least multiple time frames, I can help you. And now you're trading with congruency. You're buying dips in an uptrend, not just buying higher lows. Some of you guys buy lower lows. Like, not only do you not have the analysis, you're really a bad trader. And we can fix that because it's so simple to fix. If you buy lower lows, you're going to go broke. You buy higher lows. It's just that simple. Now, once you have all of that, so like Monday, right? Monday dollar. And David, I know you guys have been around. You've been around. I've seen some things. Hoo-ha. Bad, man. Right? So I know you know what's going on, but now it's like, okay, now how do you enter? But I start up here before I get to this page. This is pretty much the last page I look at. But the nice thing about this page is it's real time. It's dynamic. It updates itself without the page refreshing. And it's exactly my charts. Aiden, our artificial intelligence, is making the decision. 60% of the decision is fundamental, has nothing to do with the chart. 40% is technical, so it's looking at many things on the charts. I personally taught Aiden how to trade, fundamentally and technically, and he does an amazing job of both. Okay? So the second thing is then looking purely now at the chart. He's got about, I would say about 90% of my rules, maybe even more, 95% of my rules. I know there's a few situations where I have to teach him, just like it rarely happens, but in the case that it happens, I have to say, all right, handle this slightly different. But 95% of, like, this is my brain. And dude, it's weird to see your own brain. Or weird to hear yourself read the news. But anyways, Aiden sounds a lot like me. So anyways, what's going on here? Well, euro dollar, linear projection, slightly down with high volatility. All right, well, that's not bad. Okay, flat linear projection, high vol. Once again, not good. Okay, but it is bullish. But just look at the basic analysis. This is our projection in the fourth. So TRADARS has projections. I don't want to call them signals, but they are projections using statistical analysis. And then his directional bias is both technical and fundamental. The way I would. So it's very close to, in my opinion, if not precisely. But it's so sensitive to say, yeah, that's not great. Hey, what about pound dollar? Oh yeah, we're bullish. What about the charts? Yeah, they're bullish. So how about this opportunity? Yeah, it's not that great. Why? Well, we're losing momentum. I can look at this and draw a MACD. Boom. I see what the MACD is doing. But he's also analyzing. So just let's do this slightly differently for the sake of training. I'll do it in green. This is what is probably or let's say not probably, but statistically likely to happen. That's just statistical analysis. Has nothing to do with the charts. It's not doing technical analysis. This is technical analysis. It's not doing fundamentals. This is mostly fundamental. What's it doing? Well, we're calculating things like standard deviation and linear. Right? So we're trend, basically. How wide the trend is, which is volatility. Okay? And volatility is the square root of variance, which is equal to standard deviation. So we're looking at the magnitude, the volatility of the trend, and the direction of the trend. And so I look at this and like, okay, we're bull. Is the market bullish? Yeah, 21's above the 55. Yes, we're above the central pivot point. All of that's bullish. Everything's good. But it ain't happening yet. It's too early. Done. But you may not want to wait, right, Monday? Right, David? But you can very quickly see, well, it's not set up now, but you're like, what if it takes off now after the news and gets to our best case? So now we're projecting best case, base case, worst case scenarios. So you're trying to figure out, are we going to hold on top of the central pivot point? And if we do, because we're bullish, we would expect, in particular after a Fed meeting, okay, we don't expect this, but if it occurred, you better respond, because that's a big deal. Right now, this hasn't taken off, but it might. So now it comes down to, if you go to your 15-minute chart, and this is all about entry now, guys, are you looking for something like this? That's your entry. Now, to understand that, you have to know that this is a buy zone. This is based on what happened yesterday. Okay. Now, this is how clever this is. Because remember, Aiden is not plotting a chart. We don't have a charting software package that we're using. We're actually doing the live pricing and calculations in real time. He doesn't know anything. So, but he knows how to trade. So I say, Aiden, look at all the fundamentals and technicals. There's a lot that goes into that, by the way. A lot that goes into that. By the way, the chart's just all updated. Can you see that? Yeah. Okay. And based on what you see fundamentally and technically, are we bullish or bearish? Oh, we're bullish. Okay, done. So now he goes to the charts. Okay. I know the scale isn't right. I'll fix it. It's coming up. But imagine what he thought. This is just a day trade, right? Okay. Let's do change color here. Okay. What he's thinking is this. That's the plan for the day. So what I'm getting at is there's no bearishness on this chart. This has nothing to do with bears. There's no resistance per se. What happens is, if you're a bull, and he's a bull, bullish but conservative, which exactly what I would say. Exactly what I would say. I'm bullish, but I'm conservative. The second thing is, okay, if you were going to buy, okay, cool, that's where bulls would buy. Now, do they buy right before a Fed meeting? No, probably not. And then what is this? Is this a sell zone? No, it's not where bears sell, it's where bulls sell. Bulls buy in the green. and bulls sell. So often you hear that this is all about bulls and bears battling out. No, it's not. There are many, 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 many situations where you'd have to be an idiot to sell. You're like, well, why does it fall? Well, you would be an idiot to sell as a bear. Like, let's think about euro dollar. I know there's a psychological level up there, and let's say none of that exists. Let's go with the fact that we're bullish, and it makes a higher high. Okay, a situation like this. Okay, it is bullish. So what knucklehead would sell a higher high? Yes, Monday, that's today's target. This is what M4 is you could take profit. R2 is you should take profit. R3 is you must take profit. Now, I spend very little time on such pissy little 15-minute chart trades anymore. This is for the kids. 15 minutes or less, you could do it. It's perfectly fine. I'm very good at short-term trading, but I can't do it unless I have a long-term strategy, a long-term plan, long-term analysis. But like, for example, let me teach you about consistency. And we were talking about this earlier when we were in this view about how you can just quickly, you should already have made a decision. So imagine going back to the idea now of portfolio construction and management. I proposed not long ago at traders.com in our recent webinar, like, what if you decided that you were going to be permanently bearish on the US dollar? You've just decided. Well, now, with that in mind, you can go through and look at our seasonality radar I was showing you and pull up the dollar index and say, when are the best times of the year to sell the dollar? And when are the worst times of the year to sell the dollar? Otherwise, when does dollar get strong? And you plan your whole year out. You can plan your vacations on this because you know what's probably going to happen based on true probabilities. Because I go back 20 years of data in these calculations. So when you look at the dollar in 20 Januaries, 20 Februaries, 20 Marches, 20 Aprils, all this kind of stuff, after a while you see patterns and probability. You don't know what's going to happen, but you know when you should probably go on vacation, knowing that your portfolio is probably fine and there isn't anything that's going to like devastate, right? Okay, cool. So let's say I made a decision like that. By the way, that's a boss decision. To say, I sell the dollar. That's it. That's what I do. I sell, or the yen, or the Swissy, or whatever. You do you. You can. It's common in crypto to be just permanently bullish. Great. So what do? I buy dips. Well, what about euro dollar? If you're a permanent bear on the U.S. dollar, only buy higher lows in an uptrend. Higher lows in an uptrend. Lower highs in a downtrend. Higher lows in an uptrend. Lower highs in a downtrend. Higher lows in an uptrend. Lower highs in a downtrend. Done. Okay. So again, to answer the question, I think it was David that asked it initially. When do you buy? Right around here. That's it. Now, where people go wrong I see it all the time. They enter it in the New York session, and they're trying to figure out what to do today. They're like, I'm a day trader, so it's 10 o'clock in the morning, everybody. What's the market doing? Are we buying a dip? You know what I do at 10 o'clock in the morning? I eat lunch. Pretty much done for the day trading. And for an amateur retail trader to come in at 10 and just try to figure things out, what are we doing today? Dude, I'm done. You know, and that's the bigger miss. People are supposed to be involved down here. And so at investorbootcamp.com, which I haven't talked about in a while, it's still there. It's $88 a year. We have a course that teaches you how to do this. We call it the Asian Fade. It's like what is it, an 8-hour course on how to day trade. So it's like, what do you do between 10 a.m. and noon? Well, if you're going to be a day trader, you're probably taking profit. And that's the big thing where others are like, well, I'm going to buy it high because I'm bullish. And then it fizzles out. And you're like, oh, man, every time I buy it, my broker hunts my stop. No, you're trading. You might be, being a buyer might be the right thing to do. But you're doing it at the end of the day. Like the London market closes at 11:30 in the morning, New York time. So for you to show up at 10, and basically the Forex market starts shutting down. I mean, yes, it goes 24 hours a day, 5 days a week. But when you lose London and probably 70% of the New York traders and Asia's asleep, all of a sudden you got retail traders just trading amongst each other, just making a bloody mess of everything. And then what? Asia Open comes along, you're like, oh, good, Aussie dollar's down, I'm going to buy a dip. So we use pivot points to do that. It's incorporated in here, but if you use my chart templates, then you know we're already planning tomorrow. So tomorrow's plan is this. That's what you might be entering now or later today. You have to have that psych there. Okay, Monday? Okay, David? With that, you're already setting up tomorrow's trades. Okay? So we can see that we are bullish on Kiwi dollar. Okay, fundamentally and technically. We did climb above the moving averages. Okay. Did you see the chart just update? And we are supposed to get to this area, but we're not going to be able to do it today. We're just not going to be able to climb that. I think we've run out of time. So this is going to update as we move forward to calculate tomorrow's pivots, because we moved sideways going into the Fed meeting, and now we just picked up. So we need to draw new pivot points based on this. They're going to be tighter. That's how it goes. How do you feel about this one? Yeah. Would you sell that? Yeah. So going back to David's question, when do you sell it? Well, that's what this whole area is for. But we're already pointing out what my trade plan would be if I were me. This is how I do analysis. This is how I've been teaching for 20 years. But now Aiden can do this with you all the time, nonstop. Wayne, what do you think about USD CAD? Ask Aiden. We're bearish. It's bearish. It's projected to be bearish. Sell a high. Now, there's moving averages. There's pivot points. There's price action. There's Elliott wave. There's oscillators. Your RSI. Your MACD. Whatever. Okay. Now you have a new tool to help you with this. So now let's say this is your day trade, and you're like, okay, I'm really interested in selling USD CAD because you're bearish this, you're bullish that, whatever. You made your decision. Another thing that you can do is go back to our free tab, go to our trend radar, and let's see if this one will actually load. Yeah, it's like glitch after refresh. Now you go there and say, well, like we saw in the other chart, on the other page, we are bearish USD CAD. There it is. We're very bearish. This is a live price. Let's see if we can get this to load. I think the flashing glitch I was working on might have broke this because it uses the same front end technology to draw the charts. And our attempt to fix the other one would be maybe impacting this, but we'll see. We'll wait around. I'll click it a few more times. But what I'm getting to is David and Monday want to know, well, when do you actually sell? Cool. Well, Aiden watches this nonstop. Aiden can actually see images. I can give him charts and say, look at this, look at that. This is how I trade this. Oh, look, you know, I can circle something. Look at this. This is what it means in this situation. Do this, don't do that. And he starts learning. So now we get to this point where we want to sell USD CAD. It's projected to be bearish. It's made a lower low on a smaller time frame. We're waiting for a lower high. We see the moving averages. When do you pull the trigger? Well, that should be easy, but what's the percentage accuracy? There is no percentage accuracy. I'm teaching you how to trade. Okay, there's no system. Right? Like, so I went to Harvard for 5 years and got 2 degrees. No one pulled me aside and said, hey, let's share with you the system. No, I know how global macroeconomics works. So now, so Ashraf, if you are bearish, that is 90% of the game. You know you're bearish on USD CAD. But once you know, then the second thing is the technical analysis, right? What is your job? I sell lower highs at resistance. And that resistance can be whatever you want based on your strategy, your system, Ashraf. It'd be like, what do you consider resistance? If now you know 90% of your decision is simply to sell a lower high at resistance, well, that means you need a lower low. And that means you hate higher highs. In fact, you hate 100% pullbacks. So now you're only looking for one thing, Ashraf. What do you mean accuracy of your system? Are you going to sell USD CAD at a lower high? Yes or no? If the answer is yes, how do you define the lower high? So I have charts that say, look, somewhere between the 2155 is good. Good, use that. On other charts, we use daily pivots. It's calculating implied volatility. It's practically the same thing as moving averages. You can use Elliott wave if you like it, counting Elliott waves. You can use Fibonacci, which is just another way of doing implied volatility, which is just another way of doing pivot points, which is just another way of using moving averages. It doesn't even matter. Sell a lower high. And if you're correct on your bias, most of the time you'll be correct. What percentage accuracy doesn't matter. Some of the worst traders in the world, Ashraf, claim to have very high accuracy. Go on to any of these copy sites you want. Go on any of them. Look at all the ones with super high percentages of accuracy. And then calculate their Sharpe ratio. You would never invest that way. You would never invest to somebody. Let's see if I can get it. It's going to fight me today. You're kidding me. My fix is broken the system. All right, I'll get that up and running. But so in this case, you could sit on USD CAD. It'll show you it's down, 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 but it'll also show you it's up now. So now you can just wait for it to turn red and then you can go. So you can literally just sit on this page, open up USD CAD, and wait for the short-term trend to go bearish, and then you can pull your trigger. Which ends up being the same as anything else. You've just defined statistically that it's no longer going up, but it's falling in a short-term trend down, in a medium-term trend down, in a long-term trend down. Seems pretty reasonable to me. Okay. So for those that have high winning percentages but have terrible Sharpe ratios, what does it tell you? First of all, they don't make any money because their wins are small. Why do they care about that? They care more about their winning percentage than about making money. So what happens is they never make enough money. So then what they have to do is cheat the system. Sometimes they'll trade a mini lot. Sometimes they'll trade 6 standard lots, make 9 pips, and then they can say, look, 98% of the time we win, and we're up 30% for the month. Yeah, they bet it all on one stupid trade. And 95% of their 98% winners are a total waste of time. And any time that they have one big bet and lose, they blow up the account, they stop the service, they start another account, and they start racking up hundreds of pissy little 3-pip winners. Well, if that's all you got, boy, you're going to get whooped. What's the secret of success? Lower your risk size. You never go big on one trade. Never. You're a degenerate gambler. So you want to lower your risk. Lower your lot size. Yeah. And then what's next? Well, typically what someone will say is, well, Wayne, if I drop my lot size to a mini lot, I don't make any money. They're so small, I don't even care about them. Well, why is that? Oh, well, my average winner is 18 pips, so $18 of profit per trade is just doesn't add up. You're like, it's right. Your trades are crap. 18 pips, and you're proud of that? That's the other problem. But retail traders don't have an idea. They can't think 3, 6, 9 months in a row. Like I just showed you my gold trade plan for the year, month by month, projected in advance. Well, if you can't do that, there's no way you can think beyond 18 pips. I'm thinking 18 months, you're thinking 18 minutes. So, but if you could, you would change and say, okay, well, my number one goal is lower risk. So I got to lower my lot size. So, and here's where it gets interesting. If I'm going to make any money at all, my trade plans need to be worth something. There must be significant value in the trade plan, not the risk I take, but the plan I execute. And it's not one mini lot worth 18 pips. It's one mini lot worth 300 pips. And doing lots of those. Like, where is my chart? Here's one mini lot. Okay, I risked $100, $114 I risked on this one mini lot. I've made $144 in interest payments. I've made more in interest payments than I even risked. And I'm up 1,300% on a $100 trade. Now multiply that by 1 billion. Now you have 1,000 billion trillion, right? Someone makes a good point, plus lower leverage. Yeah, well, the thing is, it's not a big trade. It is lower leverage, but I'm teaching you to have low leverage. You don't need the leverage, that kind of stuff. You need better trades. You need to know how to trade better so your trading plans are better, so your trades last longer and are worth more. You don't need leverage unless you don't have any money or any idea what you're doing, which is a guaranteed fail. This is why retail traders fail. Like I said earlier, they have no idea what they're doing, but they think they're going to get filthy, stinking rich. You ain't going to beat me, boy. I've been doing this 25 years full time. You ain't going to run me over. So now you got to find another retail trader who will also make perhaps a trade that's dumber than the trade you just made. Good luck. But then you get into accumulation. And this is why I teach portfolio construction and management, because you're like, well, Wayne, okay, so you turned $100 into $1,300. Yeah, it's not a game changer. Yeah, we'll make 40 or 50 of these. Now, this is where what Osamu says that what's so important, the idea of lower leverage is actually per trade. Your risk is very minimal because you're not doing one big trade. You're doing hundreds of little trades, of which dozens work out and dozens break even, or small losses or small gains. What happens is it comes back, hits your stop, knocks you out for a small gain, for a break even, or a small loss. So much of them don't add up to much. But at the end of the year, you got dozens that worked out, and now, holy smokes, you made a ton of money. But the thing is, every single trade had that little bit of risk because your lot size was so small that you're risking, I don't know, 1/100th of 1%. And then you do another, and another, and another, and another, and another. And 10,000 trades later at the end of the year, you're up 1,000,000 pips. I don't know about 1,000,000, but 20, 30, 40, 50,000 pips? Yes, totally. That's not a joke. And that's a lot more than you'd make scalping, and a lot more you make when you have a 95% percentage win rate, but the 5% blows up your account. Actually, Jim, it's 11 and a half years, I think we're coming up to on that anniversary. Yeah, more than 11 years. But think about it that way, like, whoa. So each individual trade you make has almost no risk monetarily because it's so small. And therefore, you're not sweating bullets on when to get out. You're like, the only way I'm going to make any decent money is sit on it for a while. So I better know what I'm doing. We should probably put that chart up. Euro. Eurozar. Okay, so you better have a plan. You can only have a plan if you have data. Okay, mine is both fundamental and technical. I made the plan. There's the entry. I've been on this for 6, 7 months. Okay. Yeah, that Monday, the shorter time frames are for entry. Okay. But what's the strategy here? Okay. Lower low, lower high. Okay. That's why there was an entry there. It was also a pivot point that I had set up the previous week. It's already new to sell at that price, but I don't sell lower highs until I have a lower low. You guys remember we were talking about that? Yeah, I entered that trade, but I entered it July 31st. But I'm just trying to tell you, like, okay, it was bearish previously. Then it came up. It consolidated over the summer. Yeah, shocking. Then we opened up the end of summer with a lower low. I don't sell lower lows, but I love lower lows because that tells me to sell a lower high. So I created a sell zone. This was all pre-trade. Comes up, hits the central pivot point of my central selling thesis. I had no desire to buy this. And then what did it do? It made a lower low, then it made a lower high. Sell the moving averages. Made a lower low, made a lower high. You can sell the moving averages or the pivot points, or let it hit the pivot point and then get back in. But the distance between the 2155 is a sell zone. No, Monday when I took it, I told everybody, I'm going to sit on this forever. I told people, I'm going to show you how to make 1,000 pips. Let me show you. There was a question in one of our swing trading meetings. I'm like, do you want to see how to do a long-term? Actually, 2025, one of our themes was me teaching people how to make longer-term trades. So I'm like, well, let me show you how to do it. Boom. What's the problem? I just sold a lower high. What's the problem? There's no problem. Cool. Lower low, sell a lower high. Lower low, sell a lower high. Look at this. Now, every test of the moving averages are potential sells. You could sell here. You could sell here. You could sell here. But you're like, but Wayne, this is all hindsight. Okay. All right. Well, look, definitely once you've made a lower low, you have permission to sell the lower high off the moving averages. So you're in at least 3 or 4 of these. Lower low, sell the lower high. Lower low, sell the lower high. Okay. You don't consider that a lower low? Fine. You can still sell it off the moving averages. It's fine. But you're like, but, okay, well, that is a lower low, sell the lower high. That is a lower low, sell the lower high. That is a lower low, that is a lower high. But look at all the pivot points confirming every single trade confirmed in advance. So look what just happened. Okay, lower low, lower high, hit the moving average. We know that's a sell. And we want a sell after a lower low. So you're waiting for the pullback. And you know what this is? The sell zone for February. We're already done February. This is what I'm trying to say, amateur traders. When you log into New York and you're like, what's up, fellas? What's going on? What's going on? I'm already done February. And you don't know what's going on today? Holy schnicker-schnocker. I say that not to insult you. I want you to stand up for yourself and get mad and say, I don't want to trade like an amateur trader. I don't want to be blind. I don't want to be random. Like, dude, there's no excuse anymore. Okay, I want to get here. There's no excuses anymore. And if you have excuses, nobody cares. Those days are over, man. Okay, what's going on in the ends? Down, 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 down. Done. Done. I'm done. What about Aussie yen? Oh, yeah, well, that's slightly different. Cool. Now, this is just swing trading, okay? But we're using weekly and monthly pivot points. But this is pointed down. Look at that red is a sell zone. This area here, M3 to central pivot point, sell zone. Central pivot is way above this. We're crazy short and projected to fall. Things might change if we have our worst case scenario, but look at our best case scenario. Pound yen down. Euro yen down. Aussie yen up. Well, that's weird. Well, maybe Aussie's strong. CAD yen, it's actually an up. Interesting, huh? So these ones are standing out. You like the Swissy? Okay. So pass, maybe sell. You see that? Pass, maybe sell. Ooh, look at that. Beautiful. Put that on the list. That might be the next swing. It's beautiful. Look at that. 2155 cross. I see the central pivot below us, and we're bullish, so I know that we're using monthly pivot points because this is my swing. Oh, I thought it was on swing. Oh, sorry. Okay, that's day trade. So the day trade, which is really now tomorrow, everybody, the trade you enter today is for tomorrow. And we're projected now, but of course, by the time you get here tomorrow, the projections will have increased because we would have more trend data, and we'd probably, so you'll probably log in tomorrow morning, and you're like, okay, I want to trade Aussie Swissy, and we'll already be here, and you won't know. You'll enter, and it won't work out, and you're like, oh man, ooh. Yeah, well, maybe you should be thinking about this already. Look at this. It's already pre-plotted. Okay. And yeah, and so cool beans is all I can say. You want to look for confluence of weekly and monthly pivot points. We've done that for you. The quant scores +2. It's supposed to go up. Seasonally, it's supposed to go up 1.3%. Net flows, when you look at institutional positioning, week over week flow went out of Swiss franc and into Aussie. So institutional investors bought Aussie. It's supposed to go up. Investors are buying. We have a decent confidence score and a linear projection going up to 53.77 in the next few, between now and tomorrow. And you don't, like, dude, help me. What do you think? That is what I think. Yeah, David. Oh man, we're so close with the coaching staff on, the coaching platform. It's been a real beast. But when the weather warms up, I think I'm gonna swing by and take you out for lunch or something. I need you to find me seafood that's not fried. I need you to find it. A good seafood place. He's like, that's the back of my boat. Yeah. Yeah, well, grilled fish on the back of the boat. Yeah. Well, sometimes, Jim, I need time to think, right? I need time to plan. I've been grinding a lot recently. I imagine you do, and so do I, and I hope you're including me in your plans. I'm including you in my plans. We just don't have any idea of what the others do. But we're included, I'm sure. But so I've been grinding building this, and we're so close to it just being perfect, which is so good. So then the next thing is now I need to basically do a planning retreat with myself, and sometimes, that means go to Cuba and smoke cigars for a week. That sounds actually really good. But sometimes it's hop in the car. I can turn the heater on and the massaging seats. The car drives itself. So I think I'm even going to get a zip tie and tie it onto the steering wheel so I don't even have to touch the steering wheel, because it's the type of car where if I take my hands off the steering wheel, it beeps, but I don't steer. I don't even touch the pedals. It's not a Tesla, but it's pretty close. And just drive to Savannah with my eyes closed, getting a massage, doing some business planning, and I'm like, while I'm there, I'll take Pegler out for lunch because it's such a great straight shot. I don't want to have lunch in Metter, Georgia. So then, and then after lunch, I could turn around and head back home. You're quitting your job to join the community as a full-time trader. Yeah, awesome, dude. Yeah, the life of a trader for sure. So anyways, that's on my mind, David. Whether it happens or not, I'm not sure, but that's what I want to do. But I hope you guys see that even if you're just starting out and you're still trying to figure out technicals, You're trying to get trader psychology put together. You don't know what you should know. You got a lot of crap from YouTubers. Like, don't take advice from a YouTube guru. I mean, seriously. Have they ever been licensed and registered? Do they have any formal education? Have they been trading for decades? Have they ever done $1 billion in a month? But you take advice from these guys? Whatever. You can take my courses. Yeah, you can take all of my courses for $88. Other people charge thousands because it needs to pay their mortgage. All right. So, anyways, there's no excuses what I'm trying to get to. It's doing all the technical and fundamental analysis. So these are our weekly trade plans. Weekly trade plans overlap with our monthly trade plans. January is over. We have hit our targets for January. Look how clear it is. It was a buy down here in the beginning of the month, and we're still projected to hit our extreme best case scenario target. Look at the linear projections. Remember, could, should, must take profit. Well, we've blown through the conservative targets and we're on our way to aggressive targets. But the thing is, this only says buy and hold. Now, we're already through on the Aussie dollar. We've already killed it, dude. MR3. You should already be on February. In fact, I might even expect some profit taking soon just because, well, that's what you were supposed to do at MR3. But the thing is, if you don't know, you're doomed. But now that you know, now you got to surround yourself with the information of, well, why is Aussie doing so well? Why is U.S. dollar so weak? Why? And that's where the fundamentals come in. Right? And then when you have coaching from our coaching staff, so right now you only have little old me, but we got Brian. Looks like Brian is 90% up and running. The only thing is when he tries to edit things or launch things, it breaks. As soon as Brian's up and running, right? And then David and Peter and Maida will be back, you know? Okay. So let me blow you away for those that are new. This is how I'm going to get rich quick. This is how I'm going to make all my money. Most of this is free. Let me say that again. Most of this is free. You don't need a credit card. Signing up is easy. And the information is truly valuable. The bare minimum value, I would say, for our free, when you add this up, more than $1,000 a year, more. And when I first started trading, like the COT data was $300 a month. The headline radar, yeah, that was another $300 a month. This was before. So news feed. So let's say bare minimum when I started, and I think there's actually a lot more free stuff on here that's even listed here now. So I have to update this. You get way more than this. So I'm going to say I 100% am certain that when I first started trading Forex, this free subscription, I would pay $1,000 a month for. Minimum. 100% certain of that. You can have it for free. Join our community. Let's go. Yeah. And if you want more, you pay a little bit of money. Yeah. So now you really don't have any excuses. Yeah. Hey, Yeah, cool, right? So I'm saying $444 a month. So I've broken this down for you. I think these are very generous, but you could probably get cheap stuff from YouTube gurus. So I'm going to break that down. I think that's about right. And yeah, you can have it all for free. And there's even more than this. So there's my sales pitch. It's free. Yeah. It's premium. Yeah, you can upgrade. There's premium stuff. Cool. I've already replaced this page, but I still like it. Maybe I'll move. Oh, that's right. I knew what I wanted to do with this. I want to move it somewhere else. Yeah. Although this is colored, and I noticed they're not colored. So there's lots of little tweaks. This is way updated. This is way updated. So we don't even use these anymore. I have to update this. I got sick of patterns. They're okay, but I got sick of them. And so what you saw today, Aiden actually just draws my charts. And I'm like, that's all I care about. I don't care about patterns. Just give me my chart setups and tell me what I would do if I had been watching the markets for 24 hours. See, Aiden watches the markets 24 hours a day and then tells me what I would have seen if I had sat there. I hope you can imagine the amazement I feel when I know I'm watching the market 24 hours a day. Every single minute I see it. And when I sit down, boom, there it is. Holy schnocker, Aiden. Yeah. And then I liked this implied vol, but I realized it's not the vol I want, it's the trend. And so the trend one that I showed you replaces this, which is much better, where it shows one price feed, but 3 trends on 3 time frames, so you know how to buy a dip. So anyway, so all of this has just been completely remade. And it's better than this. Yeah. So anyways, whatever. That's it. So I hope you sign up. I will cut the cord. That was a long meeting, but for a meeting in which the Fed was expected not to cut, and they didn't. And then the press conference, Powell said nothing. But we were able to talk about Fed funds futures, the yield curve. I thought we covered some good things. Huh? So I hope, like the yield curve, when I look at it, I'm like, oh my God, look at the 1 month, the 3 month, and now look at the 2 year, the 5 year, and the 7 year. They're crazy, but not the 10-20. That's like, ooh, what's going on there? What decisions are people making? Oh, well, they expect the Fed to cut in the second half of the year and next year, but just by looking at yield curve, and you're like, man, I've never even seen a yield curve before. Well, it's yield curve plus stocks and flow, not stock market, but the amount of holdings and the change in the amount of holdings week over week by institutional investors of the Treasury, and the 7-day average yield to show the shape of the yield curve, and a 30-day to show the change of the shape in the yield curve. And that tells us sell the dollar. Oh,